Hello.
Hey, Mike, how are you?
Oh, there we go. Hello, hello. Make sure I can hear you. Can you say something?
Hello, hello. Can you hear
Oh,
me?
I am not hearing you.
No? Hang on one second here. Let me
Hang on a sec.
audio. I can hear you. Can you hear me?
Um, I'm sorry. Say something again, Greg.
Can you hear me?
Oh, it's coming. Why is it not coming through?
I can hear you fine. Everything seems normal on my end for what it's worth. You want me to log back in, log out, log back in?
All right, try that.
Can you hear me?
What the heck? Um, oh, hey, Greg.
Yeah, can you hear me, Mike?
Everyone else can hear you but me, so that means it's on my end. Wonder if I log out and log back in. Audio output. All right, how's that?
I can hear you, Mike. Can you hear me now?
Try something now, Greg.
Can you hear me?
Well, I'll tell you what I'm going to do. I'm just going to let you get going on this and until I can figure it out. Um, so, Greg, take it away.
Okay.
Welcome everybody to Lumber Futures from the Free Seats. I'll figure this out in a second
Yeah,
here.
no, all good. Hello, everybody. Thanks for joining us. Hope everybody had a happy Thanksgiving. We're back at it here. Let me jump into it here. Hang on one second here. Let me see. Sharing. Okay, we're sharing. So, kind of not a whole lot going on over the last 2 weeks as far as market movement here. I think the one thing that stands out, just interest rates have kind of obviously come down off of their high water mark, their intra-year high water mark. You know, 2 weeks ago, if we would have looked at 10-year notes, they were in the 3.81 area. They're 3.71 now. You've had a slight moderation in 30-year mortgage rates. And, we'll kind of jump into everything else. So S&P is still kind of teetering on the edge here. It's given buy signals, but it's kind of stuttering around. Where if you're going to start to close back under this low here, kind of the 100-day here, it just questions whether you're actually going to get a Santa Claus rally for equities. If you can kind of break out of this kind of bull flag formation here, then it still projects a move up into this 40, 80, a new high up into the 4120 area. There really isn't a whole lot of news driving the market. I know this week it was more fixated on China's zero policy, zero tolerance to COVID, and how that's blowing up in their face. There's a countrywide protest now. And so the market was a little bit concerned yesterday to start the week on the potential for supply chain disruptions and then overall demand. But we've kind of moved on that from that today, where when you shift into, let me do this, shift into some of the other markets here. The dollar has kind of gone sideways, and you can kind of make the case everything else is kind of consolidating right now. looking for some reason to break out either to the upside or the downside. The one thing in putting this chart together today that jumped out at me, look at lumber, and this is on a weekly. I'm sorry, this is on a daily, but lumber, really the volatility has been sucked out of lumber here for the last 6 weeks or so, and we've done nothing but grind sideways
What
to lower.
what volatility?
Yeah. For a market that redefined volatility, it's certainly been lacking, and we'll kind of get into the minutia behind lumber as we get later into the podcast here. But the one thing that stood out today with crude oil, I don't know if everybody saw this, but Goldman Sachs must have gotten long here. They said a high probability of an OPEC cut and expects oil prices to hit $110 next year. So obviously they must have been buying ahead of the U.S. Replacement of their strategic reserves here, because we were starting to get into the bands that the U.S. had basically told us they'd start to rebuy their WTI unleaded and heating oil reserves. To me, the thing that jumps out here is an OPEC cut, and I think OPEC has told us that you get below 80, you get below $75 in front month crude, that kind of becomes the big line in the sand. And front month crude has gotten sub 75 into the 74, 72.50 area, and we've had nice bounces back out of there. So something to watch in that. I know crude's fixated on China. You've had some spillover with other commodities fixated on Chinese demand. But I think especially when it comes to crude, watch the production side of it's going to be equally as important. And I think OPEC has kind of really dictated to everybody, including the U.S., that we don't like to live below certain thresholds. And if we get below those thresholds and they look more sustainable, we're going to do something about it.
Yeah. I think crude is such a touchy topic right now with the Russian-Ukraine war. I just don't know that OPEC really wants to be the bad guy right here. There's already a bad guy out there.
Yeah, no, and I agree with that. But at the same time, when you look at Chinese and Indian energy consumption, they have no problem turning a blind eye and buying everything at a discounted rate from Russia. And I thought it was interesting. Late last week, our administration basically told Venezuela that we would start buying crude from them again. So it's amazing how.
Now we're friends.
Yeah, it's amazing how that works. Let me go back here. When you look at 1 month returns, you can see natural gas has kind of surged ahead here. You get into some of the other physical commodities. Copper stands out as an industrial metal. The other big one here, look at how you've had a resurgence in foreign currencies here relative to the US dollar index. So euro, Mexican peso, Swiss franc, Australian dollar, Japanese yen, New Zealand dollar, South African rand. So currencies, at the detriment of the U.S. dollar, have kind of rebounded here. And then when you look at losers, unfortunately, our lumber can't seem to get off this list. And you could see crude oils there as well, and corn, soybean meal, hard wheat. And a lot of these, really are because of the concern with China as of late, as far as consumption and overall demand because of their zero COVID policy.
But check out gasoline. That's right
Yeah,
next
that's
to
good.
there.
Yeah, and just kind of anecdotally, I think for we kind of the day after Christmas, I think I paid sub. God, it was under 329. I'm sorry, the day after Thanksgiving, it was sub 320. It was 329, so even sub 320 in Ohio. So we've definitely moderated with unleaded gas prices. We talked about Treasury, and we've had this big move off of the highs again. When you look back, beginning of November, we had spiked above 4.2% on the 10-year. The 1 year, 2 year had spiked above 4.5%. And now we're back sub 4% in that 3.81 area. I'm sorry, that was that was 2 weeks ago. This is today. So and it's still kind of in that same range of 3.71, slightly lower. And then when you look at 30-year mortgage rates, 2 weeks ago, our last show, we were in the 7.36 to 6.93. Again, the high water mark on this was 7.5 to 7.75. And then when you look at it today, you're still kind of moderating sub 7.5%. And I know at the low water mark, this 30-year fixed actually spiked down to around 7.35, 7.25. So depending on your credit score, it was conceivable to see 30-year mortgage rates over the last 2 weeks sub 6.75%, which is a step in the right direction. But for me to generate anything meaningful from a demand standpoint, you're going to need 30-year mortgage rates dip below 6% for the masses. I think you're going to have to get back sub 6% to that 5.5% area to really trigger organic demand here.
And unfortunately, it's such a trailing indicator when we'll know.
Yeah.
But we got to watch for existing home sales. And when existing home sales start to move back up, you take a look at where the mortgage rates are, and that'll give you a good indicator.
Yeah, and again, that being said, we've kind of showing signs, and so I don't have this chart. I forgot to put it in here, but there's, you look at the knob spread, which is 30-year bonds versus the 10-year notes, and then you look at some of the shorter term duration interest rate spreads, like a 2-year versus a 10-year. They're all showing signs of interest rates topping out here, so that's something positive to watch. But that being said, we're still, and I think we showed this 2 weeks ago, but we're still at that high watermark threshold where, on a kind of year to date, we still have the biggest changes in record. Going back to even 1981, 82, where we still had a quantum leap higher in interest rates. So to see a pullback here would be helpful. But from where we started the year to where we're at now, even a pullback, to 6.5% is going to be encouraging, but it's still the shock and awe of what's taken place. Again, you're going to have to get sub 6% into that 5.5% area to really trigger new demand in housing. Again, that's my opinion. So jump in. I didn't have much else today. Busy day here, and I thought lumber in missing last week was good enough to kind of jump back in. But we talked about November expiration, and our last show was November expiration day. November went off at 450, 480, and the thing that stood out to me, Mike, is that it's the lowest expiration on record since March of 2020, pre-pandemic, the onset of the pandemic. So,
what pandemic?
Yeah, right. Yeah.
I just saw a stat that there's only like 28% of the population is concerned about COVID at this point.
Well, time marches on, but to me, play taps, put a flag in this. I mean, this is your sign that all things come to an end and your reversion back to the mean. And here we are. I mean, this speaks for itself. Look at this stair step down since the spring. 1420, 920, 682, 483, 50, 450, 480. Look at the pattern. I mean, lower lows, lower highs, and that's kind of where we're at right now, unfortunately.
And if Jan expired today, it's 423, 425.
Yeah. And again, I think we're all looking to pick bottoms here. But again, I thought this just speaks volumes that whatever we just went through, we're officially back to a low water mark from an expiration standpoint pre-COVID. So, I think this suggests that our 15 minutes of fame as an industry, it might not be over with, but we're certainly being relegated back to normalcy here. So the other weekly continuation, you can see we're still in this downsloping channel coil formation of interest, both on the weekly. You can see the Bollinger Band high 568, Bollinger Band low 381, and then more importantly on the daily, that same channel, and you can see the bands converging in, collapsing in on each other. Bollinger Band high is 445, Bollinger Band low is 413. So this market is grinding sideways, but at the same time, you're winding the rubber band here where you're likely going to get a breakout one way or the other. So, if you could push above the Bollinger Band high in that 445 area, which also, would set the stage for a pushback up into November to fill that November expiration gap. You've got the 50-day moving average here. So best case scenario, let's say you break out to the upside, you get the short funds to cover, you get a push back up into the 500 to 520. That's a possibility. If you break out to the downside, so really below the Bollinger Band low, below the recent low of 411.20, that sets the stage. You can see there's another Bollinger Band down in this 369. On the weekly, you've got support down in that 380. So, kind of best case scenario, you have a move back to 500 right now. Worst case scenario is a flush down to 380 to 367, or you just stay stuck in this tightening range here where you're just hemmed in between 415 and let's call it 445, and you just chop back and forth until you build open interest or have somebody willing to push us out in either direction here.
I mean, I know we're talking lumber here, but what's been interesting in the OSB market is that continued deterioration in pricing.
Yeah.
And they're still moving product, but it seems like even at the end of every week, they haven't sold enough. So prices continue their downward trend.
Well, and again, Mike, I think it's just, for me, it's know your structure. And for the last 2 years, we've lived in a bull market structure, demand-driven bull market structure where supply constraints have been supported by the demand component of lumber and building materials and housing. That's been taken out of the equation. So, what generates these spikes to the upside? Well, it's supply constraints, it's, driving short funds out of the market. But at the end of this, unless demand kind of materializes here, it's going to be very difficult to sustain these bigger moves to the upside. And again, that doesn't mean you have to have lower lows to the downside, but the upside, unless that demand can somehow rematerialize here, these are supply driven rallies where you have rail car constraints. I know I've got it in the slide deck here. CN just put something out warning people, we drop below certain temperatures, we're going to run shorter trains. There's the impending rail strike that was Congress just, I've got another slide in here that talks about they're going to pass a law that they can't strike, but we're relying on supply disruptions to stabilize this market and force it higher. Nobody's talking about all this demand hiding around the corner, and that's just going back to know your market. You're in a bear market structure right now, and again, when you look at this chart, this is your textbook definition for all markets, not just lumber, of what a bear market looks like. The glory days are gone, and this is the reality where, again, it doesn't mean you have to have lower lows, but you have to get back to some area where enough's enough and the supply side does something about it.
Right. I mean, when you take a big step back from that and you look at the March expiration or the peak in early spring,
Yep.
which was a lower high than the peak previously, right? Then you go to the right and we have a lower low. Like you have 3 lower lows in a row. You've got 2 lower highs. So that is the definition of a bear market.
Yeah. And so, spread wise, we'll kind of get into this with the CFTC numbers. But, like when you look at EFPs, November had a total of 90, which is kind of historically low, but I think that also has to do with, when you see the high numbers versus the low numbers, this coincides with market highs and market lows. There's more interest in a bull market structure to do AFPs because people can't find the wood versus in a bear market structure. Well, unless it's so obvious, I'm not going to do anything. Or I'm inclined to do something because I have to, and that's what you chalk November up to. These 90 done here were probably more contractual obligations than anything else.
Well, and November historically is not it.
Yeah, absolutely. Yeah, no, that's another great point. And so seasonally, we keep talking about finding a seasonal low. This isn't even we haven't even updated this yet, but we're still we're in that threshold now where we should bottom out. I mean, we are in that time frame where we should bottom, we should have bottomed, or we should bottom out this week into next week, and begin that stair step higher. And I think that's the market, that's the hope in trading at the basis. You look at basis between cash and futures. That's the hope right now. That's why futures is carrying this bigger premium, because people are trying to forecast a bottom here. But for me to forecast a bottom and say that futures have bottomed, cash has got to play along. You can't have cash continuing to be a declining market structure, where I think print last week at 390, realistically is highly generous. I think the reality is cash is probably sub 390 in that 370, 375 area. So until cash markets stabilize, all species, not just Western SPF, until you get a stability and signs that we've bottomed in physical cash, yeah, futures can attempt to bottom, but this is going to go back to we'll come back to this, but it's going to go back to the idea of basis, and this is where it's critical for the industry to comprehend basis here. And that, okay, at the high water mark last week, January was trading 440, 450. You had cash realistically a 390, sub 390, so that basis, you had almost a $50 to $60 basis. Does that make sense? And this is where I want to watch, where cash is, like when I look at basis right now, cash is your best buy. That's going to be the cheapest wood out there. And that's your bear market structure. When we bottomed last year, cash bottomed, futures was a stair step higher. There was a justifiable premium cost to carry to futures. This is no different. At least we have the right structure in place to ultimately put in a bottom. But I want to be very careful in chasing strength in futures. When this basis grows, do I need to be buying futures $40, $50, $60 above physical cash? No, the answer is, if anything, you buy the cash, you put it on the ground, you sell the board against it, and you just capture that basis. So I think this is critical for an industry that's been used to hitting home runs and grand slams over the last 2 years. Singles and doubles are going to pay the bills, for the rest of this year into Q1, Q2 of next year. Be willing to look at the basis more critically now and take these singles and doubles and being a cash or a futures trader, because that's what the market is telling you right now. When you look at the volatility getting sucked out of this market, this is a singles and doubles market right now.
And don't throw gutter balls.
Yeah, exactly. So going back, from a curve standpoint, and interestingly enough, we're finally at that point where, again, a reminder, May 15th, 2023, legacy futures are sunset out of existence. So that's why this curve stops here, because you can't trade beyond May. But when you look at this spread structure, $20, $25, $24, that there really isn't that much of a cost to carry in Jan to March to May, where it's not really justifiably significant the further out you go. But then when you look at physical cash, okay, is cash legitimately a 390, 370? That's where you get this big stair step up. So I think it's critical to understand basis, especially in front month futures, to where futures is only going to run so far ahead of physical cash, but at the end of the day, cash has to engage.
Yeah.
And then here's the mini. And again, you can see you can go well beyond. And again, not that there's big volume here or big open interest, but at least you have a legitimate price curve that, again, extends out to almost a year out now in the mini contract.
And look, that's delivered Chicago.
Yeah.
So $600 delivered Chicago is your most expensive contract right now, all the way out to a year from now. I mean, that right there is showing a lot of price stability, at least in the thought of the traders.
Yeah. No, and I think that's a good thing. And again, you're going to see the shift.
Actually, going back to your singles and doubles comment, $600 delivered Chicago, that's a fine price for a mill.
Yeah. I agree, and I think it's having realistic expectations, and what once was, what's the justification for that to be today and going forward? And that's I think this industry likes to live in the past, and I think there's a certain segment on the sell side that's living in the past right now, 6 to 9 months in the past, and the realization of what's available today, and again, if you don't like these numbers, then do something about it, and that's going to be the how do we get up off the mat here and get back to 500 and sustain that in futures or higher? It's going to have to be significant curtailments that materialize everywhere else outside of BC. We know what BC is. So when you start to see the curtailments materialize in Pacific Northwest, in Alberta, in the East, in Euro, even Southern Yellow Pine, then you know that returns mean something to the sawmills. But until you get to that point, then it's apparent that we can live at these numbers a lot longer because the pain isn't that deep just yet. Basis wise, there's March, May. Getting into open interest, 2 weeks ago, we were at 23.81. This is still with November still on the board. Fast forward to today, we are 24.59. So that's encouraging that we're kind of maintaining open interest here and slightly building. And then here's the mini. And so this is the one thing I'm asking the CME to do, and I'm hoping that they can figure this out. But we're asking the CME to move they've got the legacy and then a whole giant blank page. We're trying to get them to move the mini onto the same page along with the mini options. So you can trade options, you just have to trade the mini options. But it would be a lot easier for the industry to see this if it was all on one page on CME, their daily bulletin. So stay tuned there. So CFTC numbers 2 weeks ago, you can see that the funds are still this massive position. They increased 507. Fast forward to the latest release, we're down a little bit, but when you look at total fund short position relative to everything else, I think the ratio is like 14-1. So that's the one obvious known here. The bull in the China shop is still these guys. Pure and simple, managed money short funds are what you should be watching as far as, if we're going to go lower, it's going to be twofold. It's going to be cash is just going to erode down to 350, 370, and it's going to drag futures down with it. Or you retest the recent low, this 411 area in Jan, and they decide to come in and sell it again and just kind of keep hitting Jan to the downside. Without the new selling, the industry is having a very difficult time justifying chasing strength in January and March because of that basis we just discussed. But at the same time, the industry is equally having a hard time selling because of the what if scenario of what if these guys short cover. I don't want to stand in the way of a move back to 500. So here we are where the industry again is looking for lower numbers to buy futures, but is afraid to sell current numbers. The basis has to be so obvious because of the what if scenario with the managed money shorts.
I'm going to jump out on a limb and say that increase, the 133 increase on the industry short, I'm going to say that was probably some guys stepping in on some basis trades.
Yeah,
because
yeah.
you pointed out the basis went out to like $50, and then I'm sure on some certain items it was even wider. So that's probably something just to keep your eye on. When the $50 basis is not bad. That's definitely a double, not a single. If you're
Yeah,
gonna
and
be
so
able to
then
trade out of that.
and I agree with absolutely, Mike. I think that this is more industry participants than sawmill participants. And so the one thing I'll say with basis is you're not trying to capture 100% of the basis move. You're trying to capture 85% of the basis opportunity. And then the other big thing is I'm a basis trader if futures only sells off. I only want to do basis trades if I make money on the short side of futures. That's not basis trading, that's speculating. All we care about from a basis standpoint is the convergence between basis, cash, and futures. And I don't know if that convergence is going to be cash rising up to futures, futures collapsing down to cash. All we care is that the convergence takes place 80 to 85 cents on the dollar. Anything beyond that, when you hear the bad stories, I got caught in this basis trade, well, you're speculating. You can't put the wood on the ground. If you can see it to duration, if you can see the trade, the basis come to fruition, and you're going to capture 80, 85% of that basis trade when the opportunity presents itself. But anything to say, well, I don't want to sell futures because I'm worried that these guys could short cover. Okay, that I get that, but that's speculation, and that's part of the problem when you go back to that weekly continuation chart. The sawmills have been speculating all the way down that there's going to be somebody just around the corner to bail them out, and here we are. Where stop speculating. You use basis to your opportunity and be willing again to trade for those singles and doubles, and that's where the basis comes in, where it's highly high statistical correlation type basis, and that's what you're looking. That's going to be the opportunity, in my opinion, moving forward, where it's again those single and double opportunities. But again, this is the 800-pound gorilla in the room, the one to watch, and this makes my job, it makes our job a lot easier, knowing that these guys are in the market, knowing that they have to do something before the end of the year. They either have to liquidate or they have to roll. They don't have to liquidate, but we know that at the very least they have to roll. They have to liquidate this Jan short position via the roll. So that's something to watch going forward as we turn the page in December here. The other thing, car velocity, rail obviously is in the news. So far car velocity looks good. Canada is kind of in the middle of its previous year's range. When you look at the U.S. has been sluggish here because of the impending threat of a strike. The earliest that they could strike is December 9th, but then the news today, this literally just came out. So both Democrats and Republicans agree on getting bill preventing rail strike done as ASAP. So the idea is that you're going to see Congress legislate something to prevent the railroad unions from striking, which is, it just goes to show, what a monopoly this industry is, to have this kind of, power where we're going to legislate something to prevent people from striking. And then the other thing, the CN just put this out, and again, if we drop below certain temperatures, you're going to run shorter trains. So this notice was just put out today by the CN.
I mean, this is nothing new. That's what. It's funny they put the notice out, but it gets cold every year.
Well, and I was just talking to somebody about this today, Mike, that 4 years ago, winter weather was bearish for the markets. Somehow the railroads dealt with it, but over the last 3+ years now, we get winter weather, we get cold temperatures, and it becomes bullish because of the ineptitude of the railroads. Somehow, we have to run smaller trains, we have to close switches. This was never a problem up until the last 3+ years ago. So that's the
I mean, there's
amazingness of, again, you want to talk about the ultimate monopoly here. You're looking at it.
they definitely have some challenges with regards to labor, but yeah, this is. I think they're going to do just fine.
Yeah. So that's all I had. We'll obviously have more. We've got jobs coming out on Friday of this week, so that'll be a good. The fear is that if the jobs number is too good, then that accelerates more aggressive rate hikes by the Fed. So we'll definitely have some housing related news for next week's show. And in the interim, I guess the one thing I just want to reiterate is it's okay to trade for singles and doubles now.
And I'm still keeping an eye on China. That situation over there it's a big deal. It really is. I don't know that we want regime change, if that's what it comes down to. That instability in the current, market, or the current environment's probably not so good. But we definitely, from overall economic standpoint, we would like to see China open and running, and they have proven in the past can affect the lumber market through their huge appetite. We know that they haven't been building, and they've probably still been creating households. So I think that's the canary in the coal mine for me right now.
And I think that if China would have a change here as far as their public policy concerning, we're going to loosen things up. It is what it is. That's obviously a huge tailwind for the markets, that if you get China to consume on a more normalized basis, that could be huge for commodities just from a consumption standpoint. But the other black swan is that they take this to the extreme. You get a Tiananmen Square type revolt where they crush it, violence, whatever. That could be a black swan event to watch for with equities in a negative way. So I think China is huge in either direction.
And I think we could be kind of stagnant for longer than anyone anticipates. Just the mood in the market coming back from the Thanksgiving holiday. I mean, yesterday and today, it's been very lackluster on both sides, the buy and sell side. So, if we just kind of limp into the end of the year, limp into 2023, we could be kind of going nowhere fast for quite a while.
Yeah. And again, Mike, I think that's why it's critical. You're going to do anything with futures, watch the funds, because that's the one given in the market right now. I think we're all equally as good as bad as trying to project market bottoms and tops, but almost as certain as the sun comes up in the morning. When the commodity funds are engaged to this extent in futures, you got to pay attention to that, because that's the
opportunity.
Exactly.
When they push the market in such a way that causes a disruption or a disconnect between cash and futures, take advantage. 100% take advantage. And absolutely. I think that's going to happen as well. I think probably between now and the end of the year, there will be a massive basis opportunity. But you're going to have to sit on it for a little while. It's not going to be a 1-2 day trade. It's going to be a 1 to 2 month trade probably.
Yeah. And I think that's the idea of having to put wood on the ground. Absolutely. I think that's kind of the freewheeling days of trying to basis trade with stuff rolling. I think unless the volatility returns in a dramatic fashion, no, it's going to be more, again, where I think, and it's lumber. So, have the right to change this as soon as possible because it's lumber. But I think you're going to see more of a normalized market going into next year, where instead of trading in $300 to $500 ranges, you could be more normalized in an $80, $120, $150 trading range.
Indeed. All right. Thanks everyone for stopping in. We will see you next week.
Thanks a lot, everybody. Thanks, Mike.
Bye.
Take care.